Good day, everyone. Welcome to another episode of Let's Talk Commercial Real Estate Investing, the Black Edition, on Education Wednesdays. I'm your host, Dominic Green, Managing Partner of Technical Commercial Real Estate Services. Here on Education Wednesdays, we talk all things commercial real estate, where we're providing insight, talking about opportunities, things that we're seeing, trends, sharing information with one another. All for the purpose so we can acquire, own, and receive cash flow from the properties that we own, and building a network of opportunities for each other, leveraging each other's skills, experience, resources, networks, and the likes. So, as always, share, subscribe, like, leave a comment, because we can only grow together if we work together. So today, I just wanted to pop in here briefly, talk about a couple of things. Most importantly, yield. If you are an investor or currently investing or not, the mantra right now is everybody's chasing yield. There's a lot of cash looking for opportunity, especially with this pandemic. Kind of almost being past us a little bit. The vaccine's out. Certain states are open, like Texas is all the way open, although there are still mask mandates by the businesses. So some people are getting back to somewhat similar to normalcy. People are out shopping, people are out eating, people are gathering, people are taking trips. If you haven't noticed, people are on flights, going overseas, traveling. So things are kind of getting back to some semblance of normalcy. Some of the things that happened during COVID are probably going to stick around. But for the most part, we're talking about yield. So, you have a lot of investors still looking for multifamily, which I still, believe is a great opportunity. But what I also believe is, there's only so, you have people having the mantra of they're just buying, no matter what the price is. And I guess it just really depends on what your strategy is, right? If you just plan on buying property as a trophy and holding it for generations, then necessarily what you pay for is not an issue. However, if you are buying something with the purpose of fixing it up, adding value, there's a certain different calculation, especially if you're raising funds to actually buy it. You got to still be able to pay your investors, especially if you're offering them what's called a preferred return, whether you pay that out quarterly or monthly. Otherwise, it accumulates. And depending on how you structure the deal, you, as the sponsor, may never get paid besides the fees that you collected up front because of the terms and conditions that you set forth, and that these preferred returns that are not being paid accumulate over time, and then you have to hope that you're able to sell the property for more than what you paid for, with the expectations of raising rents at a certain percentage in line with the amount of money that you paid to fix the property and to add the value, that you're able to get that money back and be able to pay them in the return that you said that you're going to, or targets that you said you were going to do. So with that being said, I'm looking at, myself and, looking at some of the family opportunities, stuff that's on the market, that's not on the market. Because I do believe that, as far as from a trend standpoint, you're always going to need a place to live. So that should be something that we should still definitely acquire. And while that, in the meantime, I believe that from a yield standpoint, which, prior to, and maybe still somewhat as, retail has been kind of the apocalypse of, like, if nobody should touch it, you shouldn't be involved in it. And in that instance, I agree, depending on what type of retail. A lot of times what happens is, because the news, all retail is lumped in together. There's some retail that's doing good, there's some retail that's doing bad. Like I said, restaurants took a big hit. And if you watch any of the previous videos, I talked about how, even with that being said, you have a lot of restaurateurs, QSRs, that are looking to expand, taking the lessons that they learned, wanting to improve, wanting to have drive-throughs, freestanding locations, end caps with drive-throughs, really investing in mobile, where mobile used to be maybe a cute thing to have. Now it's a necessity. And then it's as far as like people buying. I mean, I don't know if you've been out this past weekend or not, but there was a lot of people out there shopping, enjoying themselves, having a good time. The gyms are back opening. People are back at the gyms. At one point, gyms were a big opportunity to invest in because, hey, the trend of being healthy hasn't really changed. People are doing it from home, but also, again, the parking lots. If you go to the parking lots, if you go to the places and you look, you'll start to see it before it even hits the news. In most cases, the news is usually a lagger. But if you're out every day looking at opportunities and you see it, you'll see that, hey, the parking lot gyms, especially I forgot what the category is called in it, but your fitness connections and the like are packed. So what does that mean? That means there could be an opportunity there. You have a lot of your big box retailers are going out. So if you're looking at acquiring a retail property that does have big box, which I would advise, to be varied and do your due diligence, because the trend in retail is mostly people are getting, or using smaller space, and the use for large big box spaces are limited. There's only so many operators that can go in those spaces, right? So you definitely want to do your due diligence. That can be an option. And then just pay attention to, what's going on as far as like who's actually leasing spaces. A lot of times what you're seeing is they're subdividing these spaces, breaking up, making them a little bit smaller so it can be used, which, is a cost in itself because now you got to add demising walls, HVAC, plumbing, all the stuff that adds up. So you definitely want to make sure you're compensating for it. But I think retail is an opportunity to get better yields, especially if you're looking to syndicate, looking to pay a preferred. You definitely want to make sure your preferred is less than, so you have a spread less than what the you're going in cap rate. You make your money when you buy, and you only realize it when you sell. So I think that's an opportunity to look at. And just be, do your due diligence. Understand, who these companies are if you're looking to buy a retail shopping center, which, in my opinion, grocery did real well and has always been doing well. People still going to the grocery store, even though you can, it's evolving to where it's convenience, right? So, hey, do you want to actually go shopping, or do you want to do a click and pick up? Still, every time I go to the grocery store, there's still tons of people in there. Then you also have people there that are picking up. From my personal experience, and you can kind of relate to your experience, oftentimes I've done both. What I've come to realize is that when you're picking like your vegetables and fruits and stuff like that, you're not getting the same due diligence or integrity of the people that are picking it. Even if you watch them, they're in there just picking based on the order, not necessarily looking at what they're picking up. So you got to pay attention to your produce. But like I said, grocery anchors, some shadow anchors. You just gotta, if you're looking at those particular property, and all shadow anchor property is a property that is, slightly off to the side, maybe a mile. That's not even a mile. Maybe a quarter of a mile, probably even less than that. Could be on the opposite side of the street, where it's feeding off of a generator. So that could be another grocery store, that could be a lifestyle center, that can be a big box that's drawing in a lot of traffic. So usually, like I said, it involves around food, entertainment, grocery, the likes. So because you're going there for that main purpose, you also will see their properties, the shadow anchors. And then typically in those, you have some food, you have your dentistry, you have your bakeries, and little small fitness like your boxing, title boxing, stuff like that. So stuff that, that couldn't get into that grocery anchored because of space. There's opportunity in the shadow anchor, and you just got to pay attention to what's already there, what's missing from that. And then, but me preferably, if anything, I would consider more of the outparcels of grocery anchors, in my opinion. Maybe a shadow anchor too, but preference wise, I would be looking at outparcels. And the main reason is because, from experience of leasing, helping clients lease spaces in shopping centers, what you realize is that from a rent standpoint, you can get a higher rent in the outparcel than you do in the inline, right? And you got to think about it. So when it comes to retail is all about accessibility, visibility. So the closer you are to, the main thoroughfare, which is the street, freeway, or whatever the case may be, the more visibility you have, the people can see you, the easier they can get to you before, you get into the actual grocery center. There comes a premium for that, right? Because retail is about being seen and heard and having it easy and being convenient. So the outparcels, which typically can be 3 to 4 units and sometimes just 2, you'll see scenarios, the ones that have like a wireless and then a dental, or a quick service like Dunkin' Donuts if you're on the AM side of the street, and then a dental, or an AT&I, which is therapy franchise. You'll see, or Leslie Pools in some instances. You have the opportunity to collect higher rents, which means it impacts your cash flow, so you get more cash flow in a sense. You have some product that's usually in demand, because especially if you follow the principles of retail, which there are many of them, and one of them being, as I stated probably in one of the videos, probably can't think exactly, but real estate is nothing without the people, right? So your customer is the business. What does your business want? That's what you're presenting to them. This is what you're offering them as a value. Hey, I own this property on such and such parkway that has a minimum 25,000 vehicles per day. It's closer straight, has easy ingress and egress. There's 3 parking spaces per 1,000, or 4, depending on what the city you're in. So there's plenty of parking. We have the ability for a drive-through if you're a QSR. The building's been updated, new paint, new appeal. Maybe it's in shell condition, so it allows you to come in and do what you need to do. The demographics around minimum. Well, people, when you see the advertisement for these deals, you'll see a lot of them leveraging the average income. Being that I had a background in economics and statistics and stuff like that, averages can be manipulated. So I looked at the median. The median income gives you more of a true story, because remember, averages, you can have very highs and very lows, and so your average can be all over the map, and it can not necessarily give you the full perspective of what's the income levels is, or demographics in there. So I usually look at median income. So the median income is 60,000, which means majority of people have somewhat disposable income, which is great for a business that sells services and products. So that means your customers can not only afford to pay for their living expenses, but they also have extra income to buy your product or service that you're pitching them, right? Now the latest thing is also you have where they're tracking your phone. So every time you open up an app, or you're traveling with your apps open, or using your phone, that data is actually being transmitted. And so if you visit certain locations where they have like geofences around their particular locations, and you're checking in and things like that, they'll track that information. And so you can use that information from, if you're able to get it, as an owner of property, and say, hey, here's how many people there is at this particular time of the day. And these people visited this particular location and this particular business. Say if you have a vacant space on your property. So these are your particular customers here. And as a retailer, you're like, okay, great. So, during these times of day, I can kind of estimate what to expect. My projections of revenue, this location is visible, so forth and so on. So it makes it more valuable. Thus, you get the premium rent, thus your NOI increases, right? So another thing that I like is, it comes with the risk and reward, right? So you always got to think about, especially when you're buying retail or, in my opinion, any type of property, more than likely other than multifamily in a sense, who is the next, or who are the possible backfields, right? If this place went dark, if my tenants went vacant, even though I bought it, there's people there, maybe some vacancy, maybe it's 100%. Who are the potential backfield tenants that I can go to that service this type of demographic in this area? And more than likely, again, you have the flexibility when you own outparcels, not necessarily being somewhat reliant on the main driver, because again, you're closer to the street. You have the better visibility. You're still in the income area, but let's say that grocery store for whatever reason closes, that movie theater for whatever reason closes. The people that are usually impacted first and the most are the people in the back or the inline, right? Because they can't be seen, and they're relying on the driver of the traffic driver, which would be the main anchor. Like I said, either the grocery or whatever, movie theater, so forth and so on. So, and oftentimes, you'll see in the leases that these co-tenants, the inline spaces, have in there a co-tenancy clause, meaning that if the anchor leaves and it's not refilled, that there's some type of penalty to the owner, which could mean that they pay reduced rent, no rent, or have the ability to actually get out of their lease. And I know during the pandemic, where a lot of owners were going back to these businesses, they were looking to seeking help, they were working to get rid of that co-tenancy clause. So they was like, in exchange for us, deferring your rent and maybe waiving a couple of months and so forth and so on, we're gonna want you to get rid of that co-tenancy clause. So, in the event that the anchor leaves, you still will be obligated to pay your rent. So, just a little tidbit there. When always hints about do your due diligence, look at all the documents, the devil's in the details, so forth and so on. And that just comes with experience of working with businesses to lease, doing my own insight into the industry, because again, this is what I'm passionate about doing, looking for opportunities to invest, looking for opportunities to put our money to work, because it's about ownership, right? And with ownership comes a certain level of power, a certain level of influence, and a level of being able to help others as well. And I think, as I stated before, I think commercial real estate is just one of those platforms to do it. Is it the one and only? No. Is it either or? No. I think it's always an and. But I think it's one of the main platforms that has proven over years. And you look at the people that are in those Fortune 500 or the Forbes or whatever list that you look at, if you look at what they actually own, again, it has some version of real estate. Some people own houses, others own the commercial property. Big businesses have been made, private equity firms have been made. Blackstone, for instance, comes to mind. One of the largest owners of commercial property. Even though they started out doing M&A, if you look at their overall business, a lot of that is commercial real estate, right? Life sciences, warehouses, multifamily, single family portfolios, you name it, right? Commercial real estate. And they have billions and billions of dollars under management, and their CEOs are billionaires. So that just goes to show you they have influence and they use their money to do all kinds of things. So not to get off track, but no, looking at Outparcel, multi-tenant properties, single tenant is another thing, and I'll definitely start talking about that a little bit next week, because I might already mentioned it a little bit, but just talking about the different sectors, different opportunities that I believe that we should be looking to consider to acquire, that I think that are also in relatively achievable to acquire from a price standpoint, especially when we're just starting out, when we're all getting together, working together. Not everybody's network has the availability to raise hundreds of millions of dollars. Some may, some not, but it's always a process. So you got to start somewhere. So just having a discussion about that. But nonetheless, when we're talking about yield again, your return on your investment, initially going in, and then unless you're doing something to it, it may be the reason you're holding it just for for generational estate, or just because it's a trophy property, you're gonna hold it forever. So what you're initially getting on a return is not as important to your primary objective, especially if with interest rates still being at all-time lows. Although interest rates have creeped up a little bit, beforehand, especially when multifamily guys were getting like 2.75 on 10-year terms, 25, 30 AM, 3 years, 3 to 5 years IO. I mean, money was just ridiculous at that. And paying attention and listening to some of the mortgage brokers, commercial mortgage brokers, saying that interest rates have creeped up a little bit. Some of the reserves have kind of dialed down a little bit with Freddie and Fannie Mac, but nonetheless, the properties that are coming to the market are still, around, that I've seen, depending on if they're class A, B, or C, they're still trading around 4.25 to maybe 5.25. So about a 100 basis point spread between the different classes. And then just depending on where you're at, like if you're in Austin, man, where I was seeing some of these class A properties and we're trading at 3.75, 3.5. I mean, just ridiculously low. And then, your older product was trading in the 4s. And what you got to realize is, again, depending on what your investment thesis is, what your investment goals are, that may not be an issue. But if you're, like I said, working to do what we're doing, syndicating, you're looking to pay a preferred, or make sure your investor gets some type of return, you got to pay attention to that. You got to pay attention to what can you do to the property to improve it, make changes, and have a perceived value that people are willing to pay a little bit more for the property, whether it's renting or retrading it once you fix it up and sell it. So all that takes into account. But you also realize, and if you pay attention, that expectations, or you should be setting expectations for your investors, that the same returns years ago are not going to be the same returns going forward. It's just really hard to eke those things out, because again, you still have plenty of money that's chasing very few opportunities, and you have some people that are just willing to pay whatever for it. When you look at some of these deals like multifamily that I've seen, and they're talking about this is a value add. Well, what are the value adds? Well, we're adding a extended patio on the first floor, so you could probably charge $50 or so, maybe not. You got to do your due diligence on that, because at the end of the day, and this is being in the brokerage world, the job of the broker is to sell the property for the highest amount in the shortest amount of time with the least amount of hassle. So, buyer beware, which is always at the bottom of all these offering memorandums. Do your own due diligence. you're doing, know what you plan on doing, and it may take several hundred looks at different opportunities before you find the right one. But it's not a race, it's a journey. For me, it's about buying quality over quantity. I'd rather have a portfolio of quality assets that I know over time will cash flow, continue to cash flow, and then whenever point in time I decide to sell them, they have some type of advantage that I can pitch to and get a premium for them, as opposed to just out buying every and any property because it's for sale. So that's kind of the perspective that I take. As well as the competitive advantage. How can this property earn, income over the long term? Because at the end of the day, you're still competing with other properties as well. I don't think it's a lot of true value adds. I think most of the stuff, in some instances, has already been picked through at least twice. So, beforehand, you were getting properties that somebody already did 75% of the value add. They left a little meat on the bone for you to sell to you, so you can, they can get out of it and go to the next property, so forth and so on. And then some now is just you're just stretching, in my opinion, for the extra, which does make a difference because again, commercial property is valued on multiples and not necessarily comparables. So extra $25 on 100 unit property adds up and adds a difference to your value. But at the same time, we all know that the true value is in not the extra 25, $15, $10 is in the can I get an extra $100 bump from actually renovating the interior unit. That makes it more valuable, that makes it more competitive in the market, because for whatever reason the owner wouldn't or didn't want to invest the money to update the interiors of the units to market or close to market, because that's typically where you're going to get your biggest bang. And then obviously decreasing the expenses, water consumption, the little things that just add to it, in my opinion. So there's only so many things you can do to the property, but sticking with the main thing being the main thing. So like I said, when it comes to yield, I always think about also educating myself, looking at stuff that's out of favor, doing even more due diligence to things that are in favor, because competition is real and spreads are small in this instance, and so it may take a little bit more time. So you got, to me, what I'm trying to do, what I'm working on doing, is taking both the approach, seeing what's available, staying on mailing lists, but also being proactive and reaching out to properties that I see that look like could use some help that the brokers haven't got to, and that the owners may be interested in doing something. You just never know. So until next time, thank you guys for tuning in. Education Wednesdays. Like I always said, like, share, subscribe, leave a comment. This is want to create a platform where we all come together, have discussions, share the information, do the things that I believe will help one another, because we can only get so far individually. Then we might get there faster individually, but we won't get far without working together. And I'm all about group economics. It's practiced with everybody else. At some point, they kind of took that away from us. But I think culturally, we all know that by working together, we can do more, attain more than you could as an individual. And at the end of the day, that's what business is, right? It's a team sport. So should investing. So whether it's with your family, your friends, people that are like-minded, people that want to achieve the same things you want to achieve, I think working together, partnerships, JVs, doing business together, I think all that helps. And so, hopefully this platform and discussions that I have on Wednesdays sparks ideas, continues the conversation. I have a Facebook group that I started. I'll actually put that in the comments as well. So, while we're not talking on Wednesdays, we can be talking every day, throwing out questions, suggestions, and the like, and building a community to achieve the same goal, which I believe is owning and controlling, so we can do the things that we want, that are most important to us, and have the financial freedom to do it as well. Because at the end of the day, we are trying to buy more time. That's the one purchase commodity we can't get rid of. So, until next time, thanks for tuning in. Like, share, subscribe, and happy investing, everyone. Till next Wednesday.